Hello everyone, my name is Sanjay and these are my colleagues Raj, Aditya, Bernice, and Samay, and we are Rubinoff and Rubinoff LLP. We are here today to provide you with our recommendations for the future expansion strategy of your organization, RSI. After a thorough analysis by our team of the various options, we recommend that RSI pursue the following strategic initiatives. First of all, to perform a financial consolidation and a partial operational consolidation with Lavish. Then pursue a partnership with Forevermore Fit Limited in massage therapy centers. And then to franchise the RSI pending the successful launch of the MTCs. And finally, to forego the opportunity to acquire Pure Substance Incorporated. We believe that this will allow RSI to grow its profitability and provide high returns to its shareholders. So moving on to the agenda for the day, first we will provide an overview of each of the recommendation options that I just mentioned. And then we will move on to some of the operational considerations and improvements that we have to offer. And finally, we will conclude and advise with how these recommendations meet your company's future goals and strategic direction. I will now pass it off to Raj to discuss the first recommendation for consolidation.
Thank you, Sanjay. The first option we will be looking at is the consolidation of RSI and Lavish. I will begin by analyzing some of the advantages of this option, followed by some of the potential drawbacks. Now, this option is advantageous for several reasons. Firstly, this option meets Sally's needs as it is consistent with her mandate of joining the spas under one cohesive brand. This will help create consistency with the brand identity of the consolidated entity, and it will be easier to manage from an administrative standpoint. Secondly, by joining RSI and Lavish, there will be one single vision and mission. As a result, it will create one cohesive strategy where both spas will strive towards, which will lead to a stronger strategic direction. There are also cost savings upon consolidation. The consolidated entity will require less employees, which leads to lower admin costs, and the combination of accounting, IT, and banking will further reduce expenses. RSI will be able to leverage Lavish's pre-established online presence, which is another example of cost savings. Furthermore, the consolidated statements present a stronger view of the company when joined together. This makes it easier to acquire financing in the future and allows the consolidated entity to meet its covenants. Lastly, there are little financing requirements for the consolidation, as there is not a need for an investment for this option. However, there are several drawbacks to consider. The management of Lavish is resisting the consolidation. This attitude can be difficult to manage when such a large change is taking place. Also, Lavish employees are inexperienced with RSI's banking and accounting, which will require additional training, and the same goes for RSI staff. Also, Lavish employees currently have a bonus program, which will mean that upon consolidation, it will need to be extended to RSI staff as well, which can be very costly. The accounting policies of the two companies also differ, which can create challenges when deciding on policies under ASPE for the consolidated entity. As it stands, both entities serve different clientele, which allows them to target a larger portion of the market. However, upon consolidation, this will be reduced and the client base will potentially be smaller. And lastly, the individual operations are presented to be more profitable than they are when consolidated due to the way intangible assets are recognized, as an example. And now I will pass it on to Addy, who will present option number 2.
Thank you, Raj. And for option number 2, we will be talking about developing a franchise of spas modeled after RSI as an expansion initiative. Some of the pros with franchising is that it's in line with the board's mandate for growth. It allows RSI to expand to new geographical markets faster compared to financing the expansion itself. And we can utilize franchisees' knowledge and experience so they can potentially improve the operations at RSI. We also have to consider the cons with franchising, and we have to carefully select the franchisees as they might have different values than RSI, which may potentially damage the brand's reputation. The expansion might also overwhelm RSI and upper management, as Sally is new in her job and other shareholders also have demanding full-time jobs. Also, screening process can also be very time-consuming and costly. So we have analyzed the total cost to RSI and marketing materials will be a one-time fee of $200,000, along with the startup fee of $50,000 for the operating manuals. There will be a yearly operating expenses of $65,000, along with training and quality control costs of $5,000 per franchise unit per year. And we've calculated that we need 8 franchises to break even, and all 8 do not need to be open in the first year. We suggest 4 in the first year and 4 in the second. And implementation will start in 2016 with finding the ideal locations and interviewing franchise candidates. Then we will continuously train, monitor, and review performances of each franchises throughout the future. So I will pass it off to Bernice with strategic option number 3.
Thanks, Adi. Next, we're going to be talking about the FFL partnership. As we mentioned in the beginning, we recommend that you go ahead and pursue the option to partner with FFL. With this option, RSI can offer customers massage therapy centers located directly inside FFL's fitness centers. Outlined, we've come up with a few key positives that we believe will be very beneficial for RSI moving forward. Firstly, this partnership will allow RSI to expand its business without taking on all of the additional risk, because the cost of the investment will be shared with FFL. Next, FFL also has an extensive customer base that RSI can leverage. According to research that was performed, customers prefer convenient locations when choosing a spa. So having a spa located directly inside of a fitness center perfectly aligns with the strategy to offer convenience. Also, one of RSI's main goals is to maintain staff retention. This partnership will allow therapists to train existing staff and offer them new opportunities and flexibility. Also, diversifying the operations of RSI is extremely positive for the company, because if one area of the business happens to do poorly in one year, the other area can compensate for the losses. We also performed a profitability analysis based on the financial data provided to us by FFL, and we project that first-year profits will be greater than 3 times the initial investment required. And moving forward, the profits will be even greater when more massage therapy centers are added. So although this partnership with FFL seems like an extremely attractive opportunity, it's still important to consider some of the challenges that could be encountered. For example, FFL is not offering RSI any brand promotion. This is crucial for brand awareness. So we recommend that you initiate an agreement with FFL to have RSI's logo visible at all locations in order to increase brand awareness and to attract customers or retain customers. Also, since the fitness centers, the massage therapy centers will be located inside the fitness centers, the success of the MTC will be reliant on the fitness center. So in order to assess the financial stability of FFL, we recommend that you get audited financial statements and perform your own analysis. In the analysis that we performed, we used the financial data provided to us by FFL. However, you should be performing your own due diligence to determine the accuracy of the data. And you should also be aware of other costs such as tax, legal, and administrative that could come out throughout the agreement. So if these challenges that I just talked about are taken into consideration and the due diligence is performed, we recommend that you go ahead and pursue the opportunity to partner with FFL, starting with 2 massage therapy centers in the first year. Next, I'll be passing it over to Samay, who will be talking about Pure Substance.
Thanks, Bernice. Next, we'll discuss the potential acquisition of Pure Substances, Inc. Overall, we recommend that you do not acquire the company, and there are a number of factors we considered when arriving at this decision. To begin, we'll discuss the potential benefits. First, since you sell Pure products and use them within your operations, you may be able to realize cost benefits through vertical integration. In addition, given that Matthew has stated that large retailers have expressed an interest in putting Pure products on their shelves, this provides another opportunity for potential profit growth. Also, we understand that being environmentally friendly is important to RSI. Therefore, you'll be able to demonstrate your commitment to the environment to your consumers by becoming a manufacturer of an environmentally friendly product. Lastly, you'll also be able to appeal to consumers by demonstrating social responsibility. This will be done by maintaining the charitable initiatives that Pure has going on in their existing communities, as well as maintaining your commitment to your existing employees. Next, let's discuss some of the potential downsides. For one, none of your existing management team has any experience in managing a manufacturing operation, which may impact the efficiency of the operations as well as impair your ability to effectively respond to any existing or new problems that may arise. Also, Matthew has stated that he is facing increased competition from foreign suppliers, which could impact profitability by depressing prices. Third, given Matthew's focus on social responsibility, he believes it is very important to keep the operations in PEI. Due to the fact that it may be more profitable to move operations to another larger plant, this would require the existing plant to close. You would have to deal with a negative PR from such a decision, which could hurt your image among consumers. In addition, given the fact that Matthew has made obligations to existing staff, there could be potential legal and ethical concerns. Lastly, Pure's financial situation has been deteriorating. While revenues have risen over the years, cost of goods sold relative to revenues have risen at a higher rate, meaning that your margins have decreased. Also, net earnings have fallen to their lowest level in 5 years. To add to this, Matthew is asking for between $8 to $9 million. However, based on the valuation we conducted, we would think that a price of around $6.1 million would be more reasonable, based on a normalized cash flows approach. In addition, considering the net book value of total assets is only $4.8 million, there is very little to support Matthew's desired price. Considering all the above factors, we believe that Pure should not be purchased. Lastly, I will pass it off to Sanjay.
Thank you, Samay. The recommendations discussed earlier all have an operational component that needs to be addressed as well. I will now walk through the operational improvements that we recommend for an overall efficient solution. In terms of the corporate structure, it is important to retain the current managers in each of the entities as they have the operational expertise required to run those organizations efficiently. In addition, it is suggested that the company go ahead and merge the support systems across the two entities, such as the administrative, banking, accounting, and information, in order to drive large-scale cost savings and drive efficiencies. In terms of the administrative functions, it is recommended that one common information system be implemented across all the spas, which will allow for the sharing of key information. Training sessions and new employee incentives will also be implemented in order to motivate the employees to accept the buy-in to the consolidation. In terms of the accounting and the financials, it is recommended that a move be taken towards adopting standardized accounting standards such as ASPE to present funders with an accurate representation of the entity's operations and financials. In order to do this, the financial statements will need to be retrospectively changed when adopting the ASPE, and in the future, if the company decides to go public or grows in large scale, they can decide to move to IFRS. In terms of governance, it is recommended that the company offer Blair Cummings to be part of the board, given his strong financial background, as the company's compliance with ASPE standards will now be strongly monitored by regulations. In terms of the mission and vision, it is recommended that the mission and vision be updated in order to incorporate the services that the spas now provide, and also to reflect the effects of the changes that the expansion plan will have on the overall corporate strategy. In terms of implementing a balanced scorecard, this will help align the business activities and the operations of RSI with the strategic goals of the shareholders, and also keep management team focused on delivering on the measures that drive success. Some of the proposed performance metrics in the balanced scorecard include things such as percentage of revenue from new sources, the number of complaints received by corporate, utilization rate, and attendance at workshops. In terms of the employee bonus scheme, given that employee retention is a key success factor in the industry, it is important that the employee retention be standardized between the two spas. Specifically, it should be broken down into two levels, being manager and above and below manager. The manager and above incentives includes things such as equity ownership, whereas the manager and below includes things such as flex time and extra vacation time. In terms of lavish, the current bonus structure, which is currently based on revenue, should be kept as is in order to avoid upsetting the employees. With regards to the franchising option, once franchising is pursued, it is important that RSI establish strong internal controls in order to ensure that the franchising are sticking with RSI's values and processes. As the number of franchises increase, RSI should hire a controller with a CPA designation. This is recommended because a corporate controller will oversee the adherence of the internal controls in order to ensure that these controls are being followed and that they are sufficient for the organization. In a summary of our presentation, we have walked through the four options of consolidating with Lavish, franchising with RSI, partnering with Forevermore Fit Limited, and foregoing the acquisition of Pure Substance. We believe that these recommendations directly and in one way or another meet the decision criteria set out by the company of meeting the vision, improving brand recognition, meeting the various growth targets, along with meeting the constraints and the financial targets, along with the resourcing requirements that have been set out. Overall, we believe that the recommendations will meet the goals of the board, increase overall profitability, and maximize shareholder value and returns in the long run. Thank you for listening to our presentation, and at this point we open the floor for any questions.